You see Steve yet, Corey? I just texted him.
Yeah, Steve just popped up, and for everybody who's in here, we'll be starting momentarily. I see Steve now.
Are you able to hear me?
Yeah, hey, Steve.
Hey, I'm not able to turn my video on. It says that the host has stopped me from doing so.
Steve, I just made you host, so try and do it one more time.
All right. There
There
I
you
am.
There
Better
it
work.
is.
Sorry about the intense Manhattan sun. It's kind of incredible. When we had the pandemic and we had, these home office setups, I think we all went crazy in making sure that they were as perfect for video as possible. I've given no such effort to my office.
Chevy, you're in New York.
Not a problem.
Yeah, I'm in.
Are you a Mets fan?
I'm a Yankees fan.
Even better.
I find that life is stressful enough. I don't need sports to be stressful and depressing. And so being a Mets fan is that's just tough.
When's the last time those two met in the World Series? Has it ever happened?
2000.
Yeah, the Subway Series.
Yep.
There we go.
Okay, well,
Didn't go well for the Mets.
Andrew, I'm going to turn everything over to you, and you can introduce Steve, and we'll get this thing started.
Awesome. Steve, good to meet you virtually. Like I said, we spoke a few times, but not lately. But yeah, looks like we got more folks coming in. But anyways, just to kick this off before I turn it over to Casey and Steve, as you guys can see hopefully you can see from the slides, Casey Curtin, Steve Cheveroni, they're from Federated Hermes. They are a asset manager that we particularly do quite a bit of fixed income management with for quite a few years here now, I suppose. Other than that, like I said, I think we got a pretty timely and interesting discussion today, kind of hitting on obviously the economy and the markets and what that means, but also as we're less than a month out from the election, definitely some talk on that, whether you guys want to hear about it or not. But with that, I'll turn over to Casey to give a proper introduction to Steve and go from there. And then Steve, I guess we'll try and maybe leave about 10 minutes or so towards the end, whenever you need to go to, just to kind of do a Q&A. There should be a Q&A box that the attendees can click into and type questions that we can monitor. We're not able to let people speak per se, but like I said, myself and Corey will be monitoring those, and we can have a little bit of a brief discussion towards the end. So Casey, I'll turn over to you and give us an introduction to Steve.
Yeah, I'll just add on quickly. I'm a regional sales consultant with Federated, so part of my job is to travel around the 3 states I cover to bring our best and brightest ideas, thoughts on the market, outlooks to our clients, such as the Briggs Group. And when I think about our best and brightest, that is Steve Cheveroni, our speaker today, or affectionately known at our firm as Chevy. I'll refer to him as Chevy. He's been with us for a while. He's been with us 17 years. There is nobody that gets asked back more in my territory from our clients more than Chevy. So Chevy, thanks for taking the time. He's got a lot of hats that he wears for us. He's head of the multi-asset group at Federated, as you see there, portfolio manager on a number of our mutual funds. If you're a fan of financial network television or radio, you'll see him on CNBC, Fox Business, Bloomberg, constantly representing our firm as the face of our franchise. So Chevy, as Andrew said, thanks for taking the time. We're a few weeks away from the election. We'll certainly want to hear your thoughts there. But before we get to that, maybe just your overall state of the union on U.S. markets, broadly our economy. It's been a tremendous year for stocks. We're bumping up against all-time highs again on the S&P over the past week or so. So we'd love to get your thoughts there. But also, to finish out, the election is just a few weeks away. I'm going to hold your feet to the fire and kind of get your thoughts on a range of possible outcomes. More importantly, how you're positioning or recommending our clients position for the other side of it, maybe next 12 months or so, given whatever outcome we might get. So Chevy, thanks for being here as always, and the floor is yours.
Awesome. So we'll do the economy first. We'll do some politics second. Try to wrap it up, kind of 30 to 40 minutes, kind of tops. Timely. Just literally, if I look at all a little frazzled or jumped on a little bit late, had a long investment discussion here with our macro committee on our economic outlook and politics and how those interact. So very much fresh and top of mind. I'd start off by saying, and I'll walk through a couple of slides. I'm not going to get too caught up on any of them. We've been under the view that the economy can take three paths. In fact, I'm going to pull up a slide on the three paths here if I can find it. Right, there's a 65-ish% probability in our view, or 60 to 65, that the economy slows some, inflation slows some, and the Fed's going to cut about 200 basis points or 2% over the course of the next, call it 12 to 18 months. That's a pretty benign environment. It's a pretty benign environment for stocks. It's a pretty benign environment for bonds. It's a pretty benign environment for the economy. Around that are two risk cases. One of them is a hard landing probability, right? So this is that, growth slows more than we expect. Inflation falls at or below the Fed's 2%. And the Fed's not cutting, 200 basis points over the next 18 months. They're cutting 300 or 400 basis points over the next 12 months. When we published this a month ago, that was a 30% probability in our view. So roughly half of our kind of base case, but not meaningless. I think that's lower today. I think that's closer to 20% today. And I think the no landing scenario where inflation reaccelerates, growth is a little bit better than expected, and the Fed is cutting rates, but maybe it's 100 basis points over the next 12 to 18 months, is still less likely, but I think that's probably closer to kind of 15 or 20%, right? So the vast majority of the probability is the Fed's cutting. It's about 200 basis points on an economy that's okay, not too hot, not too cold, and inflation that's lower, but not quite where the Fed wants it. Around that are those kind of two cases, both of which are not a zero probability, but are not nearly as likely as the scenario that we're looking at. Now, let me take you through why. To start with, inflation has come down, and by most measures, it's sitting somewhere between 2.5% and 3-ish%, which, whether or not we agree that it's the right thing to do or not, I'm sorry, my heater is bouncing around on me over there. Whether or not we think that that's appropriate or not, that seems to be the informal target of the Fed. At the same time, and this is why they cut rates 50 basis points the other day, the unemployment rate has moved up a lot. It's gone from 3.4% at its low last year to 4.1% today. And if you look at the number of job openings per unemployed worker, which was, very elevated during the pandemic, that's come back to more normal levels. So when the Fed looks at that, and when we look at it, and if you were just going to look at it on this one measure, what you'd see is that there are 11 instances since World War II where the unemployment rate is up 0.75%, which is what we're up. In all 11 instances, it kept moving higher. On average, it went 4% above its low. And in all 11 instances, you didn't have to worry about a recession that was going to happen because you were already in one. So in other words, every other time the unemployment rate is up as much as it is now, you were in a recession. I don't think we are right now. I don't think we're necessarily headed to one. But you've got to be cognizant of that history. Why don't I think we're in one? And why don't I think this is the same warning signal it normally is? Because one, no one's getting laid off. Unemployment claims have not moved up materially. So what you've seen is a surge in the labor force, a surge in the number of workers that are looking for work. That can also be an early sign of economic stress. I don't think it is here because of the chart to the right of this page. The number of US-born workers in the labor force is down 1 million people from last year. The number of unemployed workers in the labor force from outside the United States is up 2.5 million from last year. This is a lot more about immigration in the southern border than it is about any kind of economic stress pulling people in the labor force, right? Because think about it. If you have 500,000 immigrants coming into El Paso, Texas, we don't have 500,000 jobs in El Paso, Texas. So they come in, they're captured as part of the labor force, they're not employed, and you get a higher unemployment rate. It's on the denominator. So if I saw unemployment claims moving up meaningfully, I'd worry. If I saw US-born workers in the labor force moving up significantly, I'd worry. If I saw credit spreads blowing out, in other words, how much more money a company needs to pay in order to get somebody to buy their debt, I would worry, right? Because if companies are coming under credit stress, they might fire people. If earnings were falling, I'd be more worried. But companies generally don't wake up with their earnings up 10% versus the prior year and say, gee, you know, it'd be fun. Let's go fire a bunch of workers. Right? They don't do that. They do that when their earnings are under pressure, when their credit's under pressure, and that's just not happening. In fact, we just started the third quarter earnings season, last Friday with the banks, and the numbers have been good. We've been beating across the board, and the stocks have been up. All right. Let me skip ahead a little bit for the interest of time. The consumer is another area that you have to watch, and it's one where, okay, you're watching it. There are some signs of concerns, but it's not a red flag. So generally speaking, retail sales have kind of bounced around average. The back to school season looks net a little bit weak, and that's usually a harbinger of the way that the Christmas or the holiday shopping season is going to look. So there is some weakness on the part of the consumer. You have seen some credit metrics. So this here is delinquency rates for different kinds of debt. Student loan was at 0 because you didn't have to pay them for a couple of years. But what you're seeing is that credit cards and auto loans have started to tick up in terms of delinquencies a little bit. You really want to pay attention to that. But what you'll find, and it's not in this slide, is that this is really a story of two consumers. The high-end consumer is doing great. The high-end consumer's home is worth 40% more than it was 5 years ago. They've got a 30-year fixed rate, 3% mortgage on it. When the Fed raises rates, there's no increase in their borrowing costs. I'm sorry, this thing's driving me crazy. Go in the office, they said, it'd be more productive. Their home value's up. They've got a fixed rate mortgage, so rising rates have not cost them more money. They own stocks and bonds, which are trading at record highs. They're okay. They're okay, and they're spending. Now, the low-end consumer doesn't own a home. They rent. And their rent is up 40%. And by the way, it's not just low-end consumers, it's also younger consumers, right? They rent, and their rent's up 40%. And they don't have fixed rate debt. They have floating rate credit card debt. And the credit card companies are charging rates that would make a loan shark blush. And if they own stocks or bonds, they own them in a 401k, not something that's liquid that they can sell overnight. And they don't have net cash, so they're not getting the 5% in money market funds. They're paying the debt. So the low-end consumer, the younger consumer is struggling. The high-end consumer is doing fine. That matters a lot as a human being. It matters a lot as an American. It does not matter from an economic perspective as much because the high-end consumer does almost all the spending. If Federated were to pay to take you all out for dinner today, we would spend a lot of money. Casey would pull out the credit card, and a dinner with even 5 or 6 people might cost $1,000 or $2,000. That's a lot of trips to McDonald's. Less trips to McDonald's than it used to be, but it's a lot of trips to McDonald's nonetheless. And so you get an idea of how much of a difference there is in that kind of spending power. So yes, we're watching the consumer. It's a reason that the Fed should be cutting, but it's not breaking. The American consumer, when it's under pressure, will choose violence up until the moment they lose their job. And as long as the unemployment rate is generally wellish behaved and unemployment claims are generally wellish behaved, the consumer is going to spend. They might spend a little bit more, they might spend a little bit less, but they're going to spend. All right, moving on. Because of that, the Fed is cutting. So they cut 0.5% in September. The expectation from the Fed, and this is also our expectation, is that they will cut 0.5%, or I'm sorry, 1/4 point in November and December, so at the next 2 meetings, and then slow down to 1/4 point once a quarter through 25 in the first half of 26. So all told, that's 1.5% in 2024 and 2025. I'm sorry, 25 and 26, another 1% in 2024. So that's 2.5% of cuts, which would take the federal funds rate from its peak of 5.5% down to about 3, which we think is about neutral. Let's skip ahead here. As that's happened, the yield curve has uninverted. The yield curve is uninverted, not because 10-year yields have fallen, but because 2-year yields have fallen. And that's really important because it's going to have implications for a lot of other parts of the market in a second. We're not the only central bank cutting. The ECB is expected to cut again this week. The UK central bank is cutting. It's really only Japan that isn't easing at this point. So if the old adage is don't fight the Fed, don't fight all the Feds at once, I think is an equal and opposite adage if you want to know why we're hanging out at 5,800 on the S&P. What does this mean? It means money market yields are going to fall, right? Not terribly, not overnight, but we expect, that 5% that you've been earning in cash over the course of the next 12 to 18 months is going to become something more like 3, 275, 3.25. So if you find yourself with a very large cash position, you probably want to get it to work sooner rather than later. Where do we think things settle out? Again, why do we think 3 is appropriate? We think inflation is not really going to settle at 2. We think it's going to settle somewhere closer to 2.5. We think that the Fed's going to want to keep the federal funds rate somewhere about 0.5% above inflation. That's about a 3% federal funds target. And we think that, and this hasn't been the case for a while, the market is once again going to require more yield to lend longer. And so we think 10-year yields are going to be somewhere around 4%. So we're about 405, 402 this morning. I think the 10-year bond is about where it should be. We thought it was a little bit expensive when it was at 375. We thought it was a little bit cheap when it was 415. We think 4% is about right. So a steeper yield curve. Why does a steeper yield curve matter? Well, one, it means that ultra short bonds, 1-year, 2-year bonds are gonna see a bigger decline in yields, so a better return in price. So we really like the 1 to 3 year part of the bond market. But secondly, this matters a lot for stocks. If you remember in 2022, when the Fed started hiking, it was the 10-year bond that jumped. It felt like 2% to 5% overnight. And when that happened, large cap growth stocks got a lot of indigestion, right? Many of the Magnificent Seven were down 30, 40, 50%. Because you buy a growth stock not for what it's going to earn tomorrow. You buy it for what it's going to earn 10 years from now. That's why it's a growth stock. And so those names tend to be discounted or more related to long-term bond yields, right? If I'm buying this stock today for earnings 10 years from now, then my opportunity cost is the bond yield I could have returned over the next 10 years. That's not the case for small cap companies, value companies, dividend paying companies. I buy a dividend payer, not for what they're going to do over the next 10 years, but for the dividend check that they're going to give me next Thursday. I buy a cyclical company, right? An economically sensitive company, not for what I think the economy is going to do 10 years from now, but what it's going to do in the next quarter. And small caps, unlike large caps, a large cap company, when they want debt, they issue a bond, a 10-year bond in the bond market. When a small cap has a debt need, they take out a bank loan that has a variable rate, like a credit card. So if we think the 2-year yields, the short-term rates are going to fall more, and the long-term yields are going to stay higher, that favors value, dividend payers, small caps, emerging markets, more so than the large cap growth names that have dominated the market for the last couple of years. I'll give you a little bit more evidence on that in a second. One, large cap growth stocks are trading at about 30 times earnings. They've only traded at 30 times earnings during the dot-com bubble and the COVID lockdowns. Every time we've sold them at 30 or bought them at 20, we've liked that trade 3 and 6 months later. Every time we've ignored that discipline, we've kicked ourselves. So we went underweight large cap growth in July, partly on valuation. But it's not just that. If you're looking at parts of the market where you're not at all-time highs, you're not at all-time high valuations, and you've got a positive inflection in earnings growth. In other words, earnings growth in 25 that's going to look better than 24. Those parts of the market, sorry, skipped ahead one. Those parts of the market are places like energy, which is a cyclical, materials, which is a cyclical, REITs, which are dividend payers, small caps, EMs. So it's not just the valuation, it's also this story about these things are cheaper and they're seeing a positive flip in earnings. So small caps saw their earnings this year fall 16%. Next year, we expect them to grow 41%. Well, if you're telling me I've got something where their earnings were shrinking, now they're growing 41%, and I'm about 10 to 15% below an all-time high, yeah, I want to buy that. I want to buy that. That makes a lot of sense to me. How does this fit the economic view? And then we'll get into politics. Here's another thing, real quick. At the beginning of the year, the Magnificent Seven, the big seven tech stocks, saw their earnings growing 50% year over year. That's going to slow to 20 by the end of this year. The rest of the market, the rest of the S&P 500, what I like to call the forgotten 493, saw their earnings shrinking 2% at the beginning of the year. By next quarter, they're going to be growing 13.5%. I generally like to buy things that are getting better, not things that are getting less good as much. So we like this rotation idea. Small caps have followed all year rate expectations. If the Fed cuts, small caps will outperform. That's been the story. Similarly, if the economy stays stable, small caps will do better. Over the course of the last year, if you want to know why small caps have been so putrid, it's because rates have been going up and then staying flat, and the economy had been slowing. We think both of those are going to hit an inflection point. We think the economy is going to be more stable, and we think rates are going to come down. Similar story on, EM. If the 2-year yield goes up, goes down, EM is going to go up. It's been that relationship for years. Same thing, or kind of similar thing on cyclicals. This is like kind of energy, industrials, materials. If leading economic indicators get better, these things respond. And similarly for the dividend payers, if yields fall, the dividend payers are going to have their day in the sun. So that's kind of our view on the economy. Those are the asset classes we like. Let me do a couple minutes on politics and then we'll open questions. Before I go into politics, I always start with this disclaimer. Some of the things I'm about to say, because I am going to give you some opinions, are going to make some people very happy. They're going to make some other people very unhappy. I want you to know from the very bottom of my heart that I don't give a damn. I don't care. I take no responsibility for your feelings. I promise you I'm going to call it down the middle, or as best as the data tells me, but your feelings are entirely your own. I am the last American that lives exclusively by my job description. And my official job description is evil Wall Street fat cat. If you want to know my personal opinions, you have to buy me several bourbons. My job is to look at the data, see what is most likely and how that might impact markets. So as long as we live under those rules, let's have a good, honest discussion. The story here is Harris isn't there. She's not winning. Let me show you what I mean by that. And I'm actually going to use some website data because the presentation, no matter how often I update it, it changes every day. All right. As of today, Vice President Harris is leading the average of national polls by 1.4%. So wait a second, Steve. You just said she's not winning, and you're telling me that she's leading in the national average of polls by 1.4%. Okay, let's put this into perspective. 4 years ago on this day, President Biden was leading by 9.4%. 8 years ago on this day, Hillary Clinton, Secretary Clinton, was leading by 6.7%. No one has polled this poorly against Donald Trump this late. That's part of the story. Now, okay, that's the national vote. What about the swing states? Well, let's do the swing states. In Arizona, Trump is leading 1.1%. He was trailing Biden by 3.5 3 years ago or 4 years ago. He was only leading by 0.7% 8 years ago. 4 years ago, he only lost the state by 0.3%, and he won it by 3.5% 8 years ago. Let's keep going. In Nevada, Trump is leading by 0.2%. 4 years ago, he was trailing Biden by 5.2. 8 years ago, he was trailing Clinton by 1.6. Wisconsin, Harris leading by 0.3, but she has not led outright in any of the 5 most recent polls. 4 years ago, Biden was leading by 6.3. Clinton was leading by 6. Clinton lost the state by almost 1% with a 6-point lead this late in the game. Keep going. Pennsylvania, Trump is leading by 0.3. A lot more red on this than you see blue. 4 years ago, Biden was up 6-4. Clinton was up 8-2 and lost. North Carolina, Trump by 0.7. Again, it's not, this is what I'm saying here. It's not just that he's leading by 0.7, but look at these polls, and there's only one of them that has Harris ahead. Only one. So it's not like it's a flip-flop averaging to 7. It's consistently on the red, just at various levels of magnitude. Biden was up 2.8, Clinton was up 3.3. Georgia, up 0.5, Biden was up by 1.2, Trump was up by 5.3. So the only state where you could make an argument that Harris is stronger than either of her predecessors is in Georgia, relative, to 8 years ago. Because of that, the betting markets have moved significantly. So I'm going to go here, on the presidential election. And by the way, I'm going to zoom in here on a kind of, can I zoom in that way? Let me just do a 1 month view. Okay, so here's the 1 month view. Harris was leading as recently as October 4th. Do you know what's significant about that? Because this flipped on October 5th. October 5th was the night of the VP debate, interestingly enough. Either way, at this point, Trump has opened up, what is that, a 17-point lead now? Right, a 17-point lead in terms of the betting odds here? 16-point lead, it's called 16. He hasn't had a 16-point lead or anything approaching that. In other words, the numbers are looking Biden-ish in terms of the betting odds here. All right, let's move away from the presidency for a second. Well, one more comment. You can say, well, polls kind of stink, and that doesn't tell you the whole story. Look at the behavior of the candidates. So one, Trump is now holding rallies in Colorado, Virginia, and New York. You don't do that if you're afraid of winning the swing states. Harris is going on Fox News tomorrow. I can assure you, whatever her campaign strategy was, an interview on Fox News in October was not part of it, right? That's not a place you want to be if you're her. Also, and this is important, we've been able to see some of the early voting results in certain states. So Virginia, as an example, is likely to go to the Democrats. They won it by about 10% 4 years ago. However, there have been a rash of polls that have it within 5 points. If you look at the early voting so far, up to 30 days before the election, so as of 7 days ago, all early voting is down versus 4 years ago because we're not locked at home. We're not in a pandemic. However, the counties that voted for Trump in 2020, their early voting turnout is down 8% since 4 years ago. The counties that voted for Biden, their early voting turnout is down 36% versus 4 years ago. And in the biggest Democratic cities, it's down anywhere between 40 and 60%. That same pattern is now evident in early voting patterns in New Hampshire, Pennsylvania, as well as others. In addition, registrations have shifted. So Trump lost Pennsylvania by 80,000 votes in 2020. The Republicans have added, relative to the Democrats, a net of 288,000 registered voters. So you've had a 288,000 swing in a state that was decided by 80. That's where it's trending. So to me, if you're asking me today, what is the most likely outcome? I would say by about 60% odds, which is not that different from the betting odds, that Trump is favored to win. That's the state of the presidential race as we sit here today. On the Senate, this is more bad news if you're a Democrat. The Senate was always about a 2/3 odds going Republican, regardless of what happens at the presidency. And it's really just a matter of math. Because you're on a 6-year cycle, this is a replay of 2018, which was a big Democratic blue wave. So because of that, Democrats have to defend 23 seats, Republicans only 11. There's a chance that a Democrat not named Joe Manchin could win in West Virginia. It's the same chance that I'll play center in the NBA. You can't see me because I'm not standing. I can assure you those chances are extraordinarily low. So that takes you from a 51-49 Senate to 50-50. Right there. If you don't win the presidency, you got to get to 51. If you do win the presidency, you have the Senate at 50, right? John Tester is trailing by about 5 points in Montana. So if Montana falls, you now have a Republican Senate. This is a little bit outdated since 9/30. So what you will find, interestingly enough, and I'm going to come back here, is as of 9/30 when we did this, only Nevada was a kind of toss-up. Okay, if I do it today, I now have 4 toss-ups. The open seat in Michigan, Sherrod Brown's seat in Ohio, Casey's seat in Pennsylvania, and Baldwin's seat in Wisconsin. That means there are 3 races here that were in the lean Democratic candidate 3 weeks ago. They're now in the toss-up. And the reason why is because as Trump numbers have improved in the West Belt and in the Rust Belt, so have the fates of those candidates. So, for example, some of the most recent polling has the Republican candidate up in Ohio, not quite up in the other states, but within 1 to 2% in terms of the polls. So the odds here are somewhere around 75% of a Republican takeover of the Senate. The House will almost certainly go the way that the presidency does. It's tight. Generally, you come out for a president more than you do for a House race. And so generally speaking, you would expect the president, whoever wins the presidency, to carry the House. So putting that all together, because what markets care about isn't these individually, but these things collectively. If you look at the betting odds today, the most likely outcome, almost by 2 to 1, is a Republican sweep. It's a 40% odd in the betting markets. Second to that is that Harris wins the presidency, has coattails to take the House, but the Senate math is just too difficult, and that you have a divided Democratic-led government. Those are the 2 most likely outcomes today, with the Republican sweep being significantly the most likely outcome. Then Democratic sweep or Trump winning the Senate, but somehow failing to take the House are the only other 2 that have meaningful probability, but are less likely. All right, what does this mean for markets and the economy? Because that's what we're here to do. All things considered, you would expect both of these parties to spend about the same amount of money, because there's nothing that's happened over the last 20 years that would tell you either one of them doesn't spend. If we start with that premise, a Harris or a Democrat agenda probably has some higher tax rates. So, right, you're going to have the 2017 Trump tax cuts expire on the personal side. I think she would likely extend some, but probably not all of those. She's talked about higher taxes on dividends, capital gains for those making above a certain, threshold of income. I'm not even going to entertain unrealized cap gains right now. You would absolutely need a D-sweep to do that. All I'll say about unrealized cap gain taxes is, regardless of your politics or political persuasion, in the history of ideas, it might be the worst one. If you want to know why, you can ask me in questions. Probably not a lot of new things on tariffs, so not a lot of kind of trade disputes or kind of disruptive tariff policies. Probably more regulation on Green New Deal, oil and gas, financial services. Maybe they try to do some more student loan forgiveness type stuff, and probably a pretty similar border policy to what we've seen over the last 4 years. Altogether, that's probably a little bit counter-cyclical and disinflationary, right? All things being equal, if both sides are going to spend the same amount, if you tax a little bit more, you regulate a little bit more, that kind of argues for a little bit less growth. But if you don't have tariffs and you have more people coming into the country, that's a little bit disinflationary. Okay. That's probably bond friendly. You probably have 10-year yields that would fall back into the 3s on her victory. You would like longer term bonds. You'd want to be in higher quality bonds because growth could come under a little bit of pressure. And it probably is best for large cap growth companies. They're not going to face personal tax rates. If the corporate tax rate's higher, they're multi-jurisdictional and usually can kind of avoid that at some level. They do a lot of business overseas, so not having tariffs is good for them. They use more cheap labor, so that's altogether good for them. And if you don't think big companies like regulation, then why do they employ all the lobbyists? They're the only ones that can afford to comply with that regulation, so it locks in their advantage. All right. The Trump package of things is generally less taxes, right? So extend the 2017 tax cuts. He's talked about maybe cutting the corporate tax rate, no tax on tips, no tax on Social Security, no tax on overtime, right? These are all things that he's talked about. He would raise tariffs. So he's talked about maybe 10% across the board, 60% on Chinese imports, 100% on foreign cars. The thing to remember with Trump and policy is take him seriously, don't take him literally. I can almost assure you it won't be 10% across the board and 60% on Chinese and 100% on tariff on all foreign cars. But there'll be more tariffs on products. It may not be totally across the board, but it may be mostly across the board. And there'll be higher tariffs on China. Is it all Chinese imports? Is it 60%? I don't know, right? So think about it that way. The thing to remember about a tariff is it's a tax. It's a tax that's split between two entities, the exporter and the consumer. And it depends on the position of the consumer. Right now, the low-end consumer is under pressure. The dollar stores are under pressure. If a Chinese exporter of stuff that sells in a dollar store tries to raise the price to $2, they will not sell that good today. So that tax will be felt by the exporter. They have to eat it in terms of their margins because the consumer won't pay it. If you raise taxes on fine French wine, rich people are going to buy the fine French wine and they'll pay more for it. That will be a tax on the consumer. Why do I bring that up? Because you have to look at tariffs in the context of tax cuts. When you cut an income tax cut, you're cutting a tax on 100% of someone's income. When you raise a tariff, you're raising a tax on something less than 100% of their income. So depending on how you package those together, they could equal a net tax cut, they could be net tax neutral, or it could be a net tax increase. From what we've seen so far, what Trump's talking about is a net tax cut. So whether or not you like tariffs or you don't like tariffs, when you put it together, his package of goods is a net tax cut to the consumer. All right. Second point. Right now, Toyota builds Corollas in Mexico. They assemble them in Mexico using Chinese, German, and Japanese components. They then ship it in the United States through the USMCA, free of tariff. If there is 100% tariff on foreign-built cars, do you think Toyota is going to never sell Corollas in the United States again? No. And they're not going to double their price. They're going to have to assemble it in Alabama. Now, is that pro-inflation-y? Is that pro-inflation? Yes, because there's no way they produce it in Alabama cheaper than when they produced it in Mexico. However, do you know what we don't have enough of in Alabama? Everything. There's not enough factories, there's not enough utilities, there's not enough refineries, there's not enough pipeline, there's not enough apartment complexes. That is pro-growth. So it's pro-growth and it's pro-inflation. All right. He would deregulate, particularly on oil and gas and financial services, and you're probably going to have tighter borders, which means less labor. All things considered, it's pro-cyclical, pro-growth, but more inflationary. So it's bond unfriendly. Long-term, longer duration bonds probably struggle a little bit with that. The 10-year yield probably goes a bit higher. The Fed might not cut as much, but they will cut. So you're going to like cash more. You're going to like shorter term bonds more. You're going to like credit more. And you're going to like cyclicals and small caps more. And so it's not that one person wins and the market's up 20, another person wins, it's down 20. I don't subscribe to that. And I'm going to show you a chart to finish off that says trying to play that game is a fool's errand. But I do think that what parts of the equity market thrive will be different. And so we like small caps and value and dividend payers and cyclicals, not because of politics. We like them because of what's happening at the Fed and what's happening at the economy and what's happening with valuation. If Trump wins, however, in a Republican sweep, that trade will be supercharged. And over the course of the last week, we've gone from a race that was roughly a 50-50% odd to something that's closer to 60-40. So you've got to recognize that in your probability set. All right, one last chart, and then we'll take questions. What this chart shows is since 1932, the return that an investor would get if they only invested in the S&Ps, in the S&P 500 in years where there was a Republican president. And if they only invested in the S&P in years only when there was a Democrat in office. And the story is in both of those cases, you don't make any money. And the gray line is what you get if you invested through all of those times, regardless of who's in 1600 Pennsylvania. And there, you turn $10,000 into $8 million. So again, yes, very different views of the world, very different sets of policies. It is worth our attention. It will impact markets, but more along the lines of which parts of the market might do a little bit better or a little worse under each administration. Not to the tune of, oh my God, I don't like the other person, the other party's person. I want to put my money under the mattress. That is always a losing strategy. All right. So with that, I'll kind of stop. That should take us right at about 40 minutes. And I'm happy to take any and all questions that you have.
Thanks, Steve. As a reminder, guys, like I said, there should be a Q&A button at the bottom. If there's anyone that wants to type in questions or thoughts or further discussion point. While we wait for some of those, maybe, I guess, just general question, which kind of ties into what you mentioned, Steve, that if we do go the route of Trump, it feels like, I guess I'll start from the beginning on the economic side. It feels like given the unemployment number the other week, CPI last week, that you can make a small case or a moderate case that no landing probability feels like it's kind of creeping back up. So in that scenario, as a reminder, that would be inflation, not necessarily astronomically high, but stickier, doesn't come down as quickly as thought. Labor market, as we discussed, stays a little bit stronger than expected. You're not seeing the firings and whatnot. In that scenario, and then I'm going to opine this into the election comment, but what's tricky, I guess, is in that scenario, no landing, you would expect from a market impact standpoint, more of the same what we've had. Rates might be a little bit stickier or higher, so therefore you might want to stay shorter duration. In that value cyclical trade, which again, the earnings were very encouraging, as we told clients that the earnings of the other 490 or the forgotten 493 have been very encouraging and has been good to see. But you would think that might put a halt on that progress and shift back towards the growth mantra if we get into this no landing scenario.
I'd go the other way. I'd go the other way, Andrew. And here's why I'd go the other way. Because one, I would agree with your premise. Of the three economic scenarios, Trump doesn't guarantee one, Harris doesn't guarantee the other, but on the margin, a Harris set of policies is a little bit more consistent with a harder landing, and a Trump set of policies is a little bit more consistent with a kind of inflation reacceleration or a no landing, right? I think the base case of our soft landing is still in place under either victory. But on the margins, they argue for a little bit more risk in the tails, okay? But unlike the last year, I don't think Trump wins and the Fed cancels rate cuts, right? They weren't cutting over the last year. They're still cutting. Now, they might cut 150 to 2 instead of 250. So there's some information there, but they're still cutting. So I still have rates coming down. I still have a yield curve that's uninverting, right? That matters for those small caps as an example, right? Because their borrowing costs are still falling. It matters for those banks because they're now facing a steeper yield curve where they can get a better net interest margin. It's better for those cyclical companies that were facing a world where, oh my gosh, when the Fed starts cutting rates, it's going to be because we have this hard landing and they're behind the curve. No, we're going to have a Fed that said, we're not going to allow ourselves to get behind the curve. We're on this, and you're going to have some optimism potentially around growth reaccelerating. So yes, it is on the margin higher-ish for longer, but it's not the same in terms of its magnitude. It's not no cuts yet to come, a hard landing likely to come. It's more of a kind of early cycle trade. So I think what you'll see, and we saw this in July. If you look at the market action in July, right after the Trump-Biden debate, right, what did you see? You saw the 10-year yield sell off, right? 10-year yields went up, but you saw small caps and value and dividend payers outperform massively. And then when Harris entered the race, you saw that Trump trade kind of come off. So I think if you want to know what a Trump trade looks like, look at the performance of the market over the last couple of weeks, right? Where yields went from 375 to 415 up before today. Small caps outperformed, value outperformed. I think that's the trade.
Got it. Thank you. Tom, Corey, I don't know if you guys had any thoughts, or Corey, if you're monitoring the questions, if there's any or not, but I guess one other kind of elephant in the room, kind of back on the political side, I guess, and again, this ties all the way back to interest rates, I guess, is any thoughts? You know, I've heard you guys have put some interesting comments out there before on the federal debt. You know, again, it looks like there's no harnessing it regardless of who's in control or what House, Senate, you know, but there's obviously, as we continue to discuss with clients, or as you probably know better as well, that plenty of academic studies out there at what point of, you know, debt to GDP. Yep, here's some of the information I was referring to. So, you know, I guess irregardless of what the outcome is, you know, and looking more longer term here, you know, what are those impacts on both not only interest rates, which would obviously go up, but you know, inflation, growth metrics, and all that sort.
Great question. For most of the first 15, 17 years of my career, when people would ask me the debt question, you know, I'd say, look, it's kind of like the boogeyman. It's scary, but it doesn't exist as a problem, and it didn't. And the reason it didn't is, you know, look at 1990. Our debt to GDP was about 50%. And between 1990 and today, it went from roughly 50 to almost 140%. So almost a triple. And the reason why it didn't matter is because your interest expense as a percentage of GDP went from roughly 3.5% to 1.5%. And we've all experienced this in our own debt lives, right? If you owned a home in the 1980s or 1990s versus owning a home in the 2010s or 20s, or your parents owned a home in the 80s or 90s and you own a home now, you know that you can buy a lot more home when interest rates are 3% as opposed to when they're 10 or 15. And so in the 1990s, despite debt being a smaller portion of GDP, interest rates were high, so the interest expense was high. And that's when you had bond vigilantes and people concerned about debt levels. Then we went through kind of 20, 30-year period where interest rates fell. So you could add, you know how much 1.5% debt you can add when you're rolling off 10, 20% debt? Well, we finally know the answer to that. The answer is you can add 100% of GDP and only get your interest expense back to where it was in 1990. Now, the problem is that game is over because we no longer have, you know, 10 and 30-year bond yields that are 1.5%. They're now, you know, 4.5%, 5%. So this becomes much more of an issue because it's now going to eat away. Like, for example, October, and what I'm about to say is not hyperbole. October is the first month in the history of the Republic where interest expense is greater than the defense budget. That's probably not a great healthy sign. Probably not what you want to have happen. So, and by the way, we're not like Norway, where we don't have a very big defense budget. We've got a huge defense budget, and it's still bigger than that, right? So it is a little bit more of an issue, or a substantial more of an issue. Couple items on this. One, where are we seeing it today? I think we're seeing it in where the 10-year yield is, right? So when I talk about a federal funds rate that we think settles out at about 3%, but a 10-year yield that's probably more like 4%. Part of the reason why is if you're gonna lend a government with 150% debt to GDP money for 10 years, there's a little bit more risk in that than there was when it was only 50% of GDP. So I'm gonna want 1% more per year in order to give you that longer term loan, that term premium. So I think, you know, the term premium has been 0 for 20 years almost. We think that reasserts itself. How do you get out of it is really the question. How do you deal with this without this being some kind of a problem? And how does this look relative to the rest of the world? Remember that this is a debt to GDP chart. It's not a debt chart. It's a debt to GDP chart. Why do I say that? We know intuitively that if we do $1 of tax cuts or $1 of spending in the economy, it equals more than that in terms of economic activity, right? If the government allows me to have one more dollar, either by giving it to me or letting me keep my own, I don't just keep that dollar and add $1 to the economy. I take that dollar and I spend 50 cents of it with you buying, assuming you're a restaurant owner, I spend 50 cents at your restaurant. And then you take that 50 cents and you spend 30 cents on a pair of shoes. And then the shoemaker takes the 30 cents and spends 10 cents on, I don't know, a bagel. So for that $1 of tax cut debt, you might add $1.25 of GDP or $1.50 of GDP. There's a multiplier, right? So it then also stands to reason that if you take $1 out of the economy, either through higher taxes or reduced spending, you're going to reduce GDP by more than $1. So your debt's lower, but your debt to GDP actually goes up. This is the problem with austerity and why it never works. You cannot, it's not a kitchen table. When I sit at my kitchen table and I think about decreasing my spending or increasing my income, my spending doesn't impact my income. The government's does, right? Their salary also impacts their income. No matter how they look at it, it all interacts. And so what you'll find is you can't really cut your way out of this. Here's a perfect example. Imagine if, and I'm using the extreme to prove the point, imagine if tomorrow we canceled Social Security and Medicare, just canceled it, it's gone. What would consumers have to do? They'd have to save a lot more money. So if now all of a sudden people have 40% less money to spend, what do you think is going to happen to the economy? Likewise, if I took everybody's taxes and I doubled them tomorrow, how much economic activity do you think is going to get hit, right? There's a problem there. We also have an issue in the United States where no matter what you do in taxes, historically, you've never been able to get tax revenue above 20% of GDP. I don't care if the marginal tax rate's 10% or 100. At 20%, something happens. Either economic activity falls or people leave or they cheat. I don't know what it is, but you never get above 20. So the point is you can't tax your way out of it, although they'll try, and you can't spend your way out, and you can't cut spending to get out of it, which they'll also try. The only way you can actually get out of it, and it was interesting, I don't normally think of him as a great economist, but Trump actually gave an interview today on Bloomberg where he talked about this. You got to grow your way out of it. You have to grow out of it. What does that mean, grow out of it? It means that you have to engage in spending. I got another chart on this. You have to engage in spending, productive fiscal spending, that increases debt by X, but growth by X times something. All right. Neither party has a monopoly on ideas that do that. What are ideas that can do that? All right. Well, one of them is on the left. Let's talk about the kind of left's preferred infrastructure investment, right? I fly out of New York. New York has 3 airports. The only difference between us and, I don't know, Chad is that we don't have chickens running around our airports. That's literally it. They're horrible. We have trains that derail regularly. We had a freaking ship go into a bridge and knock it out in DC. At our headquarters in Pittsburgh, a bus driving down the street in front of the office fell into the road and then proceeded to stay there for 9 months. You cannot tell me that doesn't impact productivity, right? That absolutely impacts productivity. And so if you're able to spend $1 on infrastructure, good, solid, old-fashioned, not like the broadest interpretation of infrastructure, but actual needed infrastructure, you should get more than $1 in economic activity in response. On the right, corporate tax cuts and maybe tariffs, maybe, at least in the short run, could do that. Because if you create an incentive where companies that were shipping a factory or a job overseas to ship that factory back to the United States, that will increase growth in the United States. Now, What an economist would say is, well, yes, maybe, but overall global production falls or overall global prices rise. Here's the issue. The United States doesn't run the globe. They run the United States. So yes, it might lower the global output or the global profit set of automakers, but it'll increase the US's as more people kind of come back. So those are two things that you can do. Now, neither of those is a free lunch. They're wrought with, on one hand, waste and a kind of overly broad definition of infrastructure. On the other hand, for all the benefits there of tariffs, there's also the issue of its higher prices. It tends to impact lower end consumers a little bit more on a percentage basis. It takes time for those jobs to come back. There's a kind of icky feeling when you've got debt levels at this rate to, create tax incentive for big, dirty, evil corporations. I get all of that. But those are two things that, from a pure economic perspective, you can do, right? Another thing you can do is you can increase population growth. That's another way to get through this, right? Now, how do you do that? Is it legal? Is it illegal? Do you make sure that that burden? Because look, I'm the son of an immigrant from Italy. My mother will be a net draw on the resources of the country. She will receive more in benefits than she will have created from a purely strictly economic perspective. As a human being and a mother, she's paid for herself 1,000 times over. But from a purely economic perspective, she's a net draw on the resources of the firm. I can assure you, and if you want to see my tax bill, I will assure you, I am more than paying for whatever we've given her. And then some. And so, but that takes time, right? And so you've got to ask, where are those immigrants? What skill sets do they have? What's the balance between folks that can work today or folks whose children will be superstars? Do you have parts of the country that can handle that influx of immigration, right? So that's the virtue of a legal immigration system. A legal one is you can decide where these people go. You can kind of vet, you can have a desired mix of different folks. Whereas in an illegal system, it's great that you have the people, and over the very long run, that will help. But it can really hurt El Paso, Texas, as an example. And if those people are all coming into a part of the country where there aren't jobs that fit their skill set, then it creates draws on resources, and that increases debt and doesn't increase growth. So how you do it matters, but an increase in population absolutely is a way to address this problem as well. I will go by the Winston Churchill phrase. You can always count on the United States to do the right thing. You just have to wait for them to try everything else first. And I'm sure that that's how this will play out.
Awesome. I know we're running up against the hour here.
We stepped on every third rail there, by the way. We got all of them in on that.
Corey, Tom, anything else you guys had to add? Or
No, I just appreciate everybody's time. Thanks for those that tuned in. Any questions that come up afterwards, want to talk to us, give us a buzz. Steve, thanks for your time and great presentation. And Casey, thanks for getting this to happen. But no, just thank you to everybody.
Really appreciate it. Thank you so much.
Thanks, Chevy.
yeah, Steve,
Go
I
Yanks.
appreciate it. Thank you.
Take care. Bye-bye.
Casey, thank you. Very informative. And
Thank
last
you.
thing, last comment is for those still on, there should be a replay, I believe, as well.
Yeah, there is. Yep.
That Corey should be working on as well. So keep an eye out for that. But yeah, any questions, send them our way. And thanks for your time, guys. Everyone have a good rest of the week.
Take care.
Thank you.
Bye.
Thanks.
Bye.